All right, let's jump right into it. Today, we're digging into Graphic Packaging, that's ticker GPK, and their latest earnings call. Now, at first glance, everything looked pretty normal, actually. But wow, the way the market reacted, that told a completely different story.
So this is the big question, right? The core puzzle we need to solve today. Graphic Packaging comes out, they beat earnings, they beat revenue. You'd expect a nice little pop in the stock. But nope. Instead, it gets absolutely hammered, slumps to a new 52-week low. So what on earth did Wall Street see that the rest of us missed in those headline numbers? Okay, so here's how we're going to break it all down for you. First, we'll look at that beat and the crazy sell-off that followed. Then we're going to dive into the numbers to see what's really going on. After that, we'll cover the guidance and headwinds that scared everyone off, check out what management is planning for the long haul, and finally, we'll give you our take on the next call.
All right, first up, the beat and the sell-off. You could call this the market's contradictory verdict, and that really hits the nail on the head.
So let's look at the headline numbers. You can see right here, they look pretty darn good. Adjusted EPS, 58 cents. The street was looking for 56, so check, a beat. Revenue, $2.19 billion, when the consensus was $2.16, another beat. I mean, by any normal measure, this is a solid, clean beat on both the top and bottom lines.
But then, there's this number. A drop of almost 6%. And this was in the pre-market, like right after the announcement. It's like the market just took one look at those good headline numbers, threw them in the trash, and focused on something else entirely. So the big question is, what was it?
Okay, let's move on. Time to pop the hood and really dig into the numbers. We need to find the weakness that was hiding under the surface.
And here's where the story starts to take a sharp turn away from those nice, shiny headlines. Yeah, EPS and revenue were up, but the stuff that really speaks to the core health of the business, the profitability, was going the wrong way. We're talking about adjusted EBITDA and the margins. Both of them dropped year over year. And this is where those investor alarm bells started ringing. So let's get specific. Let's look at the pain points. Adjusted EBITDA, down a full $50 million from last year. The profit margin, it got squeezed by 200 basis points. That's a big deal. On top of that, the actual amount of stuff they sold, their volumes, dropped by 2%. And to capital off, their debt, or net leverage, ticked up to 3.9x. You put all that together, lower profits, selling less stuff, and more debt? Yeah, that's the toxic cocktail that spooked investors.
And that brings us to the real heart of the issue. Look, the numbers for the past 3 months were a little worrying, sure. But the real reason for that massive sell-off, it wasn't about the past. It was all about the future.
And there you have it, the smoking gun. Management came out and cut their guidance for the full year, for both sales and profits. You know, for investors, that's a huge red flag. It basically says, hey, that weakness you saw last quarter, that wasn't a one-time thing. This is the new trend. And let's be honest, nobody cares if you had a good quarter if you're telling them the rest of the year is going to be worse.
To his credit, CEO Mike Doss was pretty upfront about the problems. This quote from him really nails it. He's basically saying two things are hitting them at once. First, the average person is feeling squeezed, so they're buying less stuff, which means less packaging. And second, some of their competitors are getting desperate and slashing prices, which puts a ton of pressure on their own profit margins.
So let's just recap all those headwinds, because it's kind of a perfect storm. You've got consumers who are strapped for cash and just not buying as much. You've got competitors basically starting a price war just to keep their factories running. And then even your big customers, the CPG companies, are being super cautious with their money, so their orders are all over the place. It's just a really, really tough environment to operate in right now.
Okay, but in the middle of all this gloom, management's message was pretty simple. Hey, stop focusing on the next few months. They want everyone to look past the short-term noise. So let's do that. Let's look at their long-term play, because this is where they're trying to tell the market the real story is. And this slide, I think, perfectly captures the huge disconnect happening right now. You've got the market over here, totally obsessed with the next quarter, the weak guidance, the squeezed margins, the low volumes. But then you've got management over here saying, no, you're looking at the wrong thing. Look out a couple of years. They're pointing to this massive pot of gold at the end of the rainbow, a huge surge in free cash flow, thanks to smart investments they've already made.
And the absolute cornerstone of that long-term plan is this brand new facility in Waco, Texas. The CEO says it right here. It was the biggest single investment the company has ever made. And the whole point of it is to give them a massive long-term advantage on both cost and quality. They're betting the farm that this plant is a total game changer that will pay off for decades to come.
So here's the game plan laid out in 4 simple steps. Step 1, finish up the big Waco investment. Check, that's done. Step 2, turn off the spending tab. They're going to dramatically cut back on capital expenditures. Step 3, and this is the big one, watch the cash flow in. They're aiming for $700 to $800 million in free cash flow by 2026. And finally, step 4, use all that cash to pay down debt and give the rest back to shareholders. It's a classic pivot from building to harvesting.
So, the big question is, how do you weigh the short-term pain against that potential long-term gain? That brings us to our final section, the next call. We're going to give you our take, our rating, and a trade idea for how this might all play out.
So after weighing everything, we're giving this a market perform rating. And what that really means is it's a holding pattern. The problems right now are just too real to ignore. The weak consumer, the tough competition, that's not going away tomorrow. But at the same time, that 2026 free cash flow story is incredibly compelling. So we think the stock is probably just going to tread water until we get a clearer sign that things are actually getting better.
Let's break down the bull versus bear argument for the next few months. The bulls are going to say, look, the cost savings from that new Waco plant are going to start kicking in, and the company is buying back its own stock, which should support the price. But the bears will fire back, yeah, but the consumer is still weak, and those price wars are going to keep crushing your margins. Honestly, both sides have a really strong case right now.
All right, time for our outrageous but plausible trade idea. The whole thesis is this. The market is being incredibly short-sighted, completely freaking out about the next 6 months, and totally ignoring that giant pile of cash coming in 2026. So, the trade? You could consider long-dated, out-of-the-money call options that expire in mid-2026. Now look, this is a high-risk play for sure, but it's a leveraged way to bet that as soon as things start to look a little less bleak, the market will wake up, see that cash flow, and reprice this stock in a hurry.
So really, it all boils down to one question for any potential investor. Can you stomach the short-term pain and uncertainty to potentially get to that long-term cash flow reward? That's the trade-off. And that wraps up our breakdown. As always, remember, this is not financial advice.